Welcome to the B.F. Anderson Technical Report for September 22nd. If you are not growing, you are dying. Bear markets are all about changing of the guard. It's where companies that are no longer growing and phase out, and then you have to be patient for the next bull market for the companies that are going to phase in. Here's an example. This is a stock certificate of the New York Central Railroad Company. Passenger rail was made obsolete by the automobile and the airline industry. And, people that were buying and holding passenger rail stocks back during that period pretty much lost everything. New York Central went bankrupt. So, that's a factor when it comes to a buy and hold strategy. Here's a book that I would recommend. It's How to Make Money in Stocks by William O'Neill. And you might want to pause your video player, but there's a myth out there about long-term investing and being fully invested. You need to really realize that there are situations out there, such as Enron, where you just can't sit there and allow your portfolio to deteriorate with this kind of situation. Enron, the whole thing was an accounting scandal, basically. And I can remember a good friend of mine, his mom, a 90-year-old mom, was thinking about buying stock in Enron because it was just, it was going straight up. It was red hot and everybody knew about it. And it really had a moment there where it was doing well. So what you had to do was on anything, you should go look at the financials. And I would recommend that you use Yahoo Finance. It's a great service. It's a free service. And they have a section on there called Statistics, which gives you a complete rundown of the income statement, the balance sheet, and the cash flow. Well, on Enron, they were posting pretty aggressive earnings numbers. However, their cash flow was negative. So it really was a warning because, you can't manipulate cash flow. Now, if you go back and I do want to mention, we're going to do a little bit different this week. Wanting to take a look at some things that I think we should look at. But this is a list. Again, you should pause your video player. These are stocks that were bought in 2000 during the bear market and what their stocks ended up doing. Some of these companies did not even come back. Some of them bounced back a little bit, but you can see the dramatic drop that these stocks went through. Kind of think we're dealing with something kind of similar right now. We're seeing those kind of numbers. So back to buy and hold again. How would you like to invest in something like General Electric 5 years ago at over $200 a share, and it's currently down to around 65? That would not be a very good buy and hold. You see, the problem with buy and hold is that for every, I can count on one hand buy and holds that I've experienced over my lifetime in this business. But I can also find you about 100 examples that weren't buy and hold. So you really have to stay on top of it. And I just want to show some of the names that we're looking at today. This is Google. This really looks bad. The stock has dropped from roughly 150 all the way down to under 100, actually making a new low. And that was like one of the big names out there. Here's Facebook, which is now, they've changed the name, which to me would be suspicious in itself. But you can see also with Facebook, we're breaking down, making new lows. So basically, these are the old names that are going out, and you've got to look for the new names that are coming in. Also, I wanted to take a long-term look here at interest rates. I think right now, and I would say on a macroeconomic basis, you want to pay attention to two things. You want to pay attention to corporate earnings, which are very important, and you want to pay attention to interest rates. Well, as you can see here with the yield curve, I went back to 1990, and you can see here that we are currently getting a yield curve reading of about a minus 0.4, which the only other time we can say it since 1990, that was around the bear market of 2000. So interest rates are just not going in the right direction. In fact, I would say that this market's going to have a very difficult time rallying in any significant way until interest rates stop going up. So as you know, as interest rates go up, the value of your bond portfolio goes down. So here we have an ETF, which I think is an important indicator, and I'm going to be keeping a very close eye on this particular ETF. This is junk bonds. Now, why junk bonds? Well, we could look at government bonds, and that would be, you don't have a default risk with government bonds because the government can just print more money. But with corporate bonds, you've got default risk. And you would be surprised on how low defaults are. They're really not a big problem. But if we go into recession, you're going to see the junk bonds have a difficult time in here. So what I would say would make a lot of sense would be keep an eye on this particular junk bond fund, which is basically not investment grade bonds. And I would wait for a buy signal on this particular ETF, and I would keep an eye on the amount of volume and so forth. But I would say that interest rates are going to be very, very important here. Now, the frustrating thing about what's going on with the Federal Reserve is, this is a continuous contract. This is a futures contract for gasoline. And you can see what's happening here. It's dropping quite dramatically. Then if you look at gold, you can see gold actually making a new low yesterday. So, if inflation is really a long-term problem, I would be really, I'm really having a tough time understanding how these particular commodity situations are not doing, not going up. Like the price of lumber. Here's the price of lumber, pretty much coming down in a very big way. Now, we're going to do a shorter version of the indexes. We normally look at 5 indexes, but they all look pretty much the same. You can see here, NASDAQ broke to a fresh low yesterday. We're getting somewhat of a death cross here in the moving averages. It's pretty much telling you to keep your powder dry right now. S&P 500, same thing, breaking to a fresh low. In fact, we were looking for it to hold 3,900, which it basically blew through. Then yesterday, it actually blew through 3,800. So, what one analyst that I work with told me, he said, if we break below 3,900, there's not a lot of support here. Now, you have some support back here in the summer. But, he said basically below 3,900, there's nothing below but dragons, which means it's kind of a nasty place to be. But here's the 200-day moving average. You can see here with the index, we got up to the 200-day back in August, was rejected, and have come back down below 3,800. Here's the aggression index, not looking as good as it did last week. We were hoping that, this particular low would hold and then we'd rally off of it, but it didn't. We're continuing to break down. Again, I think a rally in the growth stocks will be critical to the market putting in a bottom. Also, I wanted to mention the transportation index. Last Friday, Federal Express came out and announced that they were going to miss their numbers, and they did not give a very favorable projection. What's happening to them is their costs are running so high because they're bringing back half-empty planes from China. So it could be just a Federal Express problem, but the fact that the transportation index broke to a new low and you've got the Dow Industrials breaking down to almost a new low, this is what you call a Dow theory sell signal. It's an old indicator, but it basically says that if the industrials aren't doing well, and then which is the making of things, and then the moving of things is not doing well, that's not a good, the market is not discounting a favorable picture. So here's FedEx. I just wanted to show you what happened to FedEx. I mean, the stock basically plummeted over 20% that day, and also it's continuing to break down. So the transportation stocks do not look very favorable. Also, interest rates continue to be in an uptrend where, actually the 2-year yesterday, the 2-year note got to 4%, whereas the 10 years at 3.5%. So that's where that inverted yield curve comes in. Price of oil trending down, financial stocks trending down. So not a favorable picture. New lows. We're getting way too many new lows. On Tuesday, we had almost 400 new lows. We need to get those new lows below 40 a day for a period of time. Now, on the top 5, just wanted to mention a few here. Albemarle continues to look positive. It's pretty much holding that 10-day moving average. You're getting some volatility in here. But there seems to be a theme out here that, Albemarle makes lithium, or they're a lithium producer. So anything to do with, EVs or solar. Now here's Enphase, which makes inverters for the solar industry. You can see it's pretty much continuing to hold that 10-day. Did give a little bit of a violation here. So, could be a warning. The selling volume kind of came in a little high. I would continue to watch Enphase. EQT, which is an oil and gas play, not really holding that 10-day, moving sideways. Also, price of oil is in a downtrend. First Solar, another one of these solar EV plays. You can see pretty much holding that 10-day. However, did give somewhat of a minor violation here just this week. So continue to watch that one. Now, Karuna Therapeutics, again, downtrending 10-day. I think I would just basically keep an eye on it. So all in all, what I'm saying is the market's in a downtrend. It's going to be difficult to make money on the long side. So just kind of keep your powder dry and be cautious here. If you have any questions, let me know.